Hello, welcome back. Mike from Canavan Wealth. What's going on with the banks? It's a crazy day. I thought I was doing a little bit of research, so I figured I'd do an article on what's going on with Silicon Valley Bank and everything. We'll talk about the markets here in a minute. So this is the main story out of the Wall Street Journal about what happened with Silicon Valley Bank. It goes through kind of the history and what happened. Really kind of a fascinating story to me because this is not, a bunch of fraud or anything like that. Let's just kind of go into what happened. So Silicon Valley Bank, as the name you might have guessed, does most of its business with kind of tech startups in Silicon Valley. And that's a very well-connected community. The article talks about how pretty much everyone in the tech startup world banked with Silicon Valley Bank as the 14th largest bank in the country. And in 2020, 2021, when the stock market was doing so well, and there's kind of, this was during the COVID years, tech was doing very, very well. They got so many deposits that they couldn't lend it all out in kind of traditional banking methods. So they ended up having to find a place to store effectively all this cash that they had. Good problem to have. Well, they ended up putting them not in speculative investments, but just in U.S. treasuries, right? Long-term kind of 10-year treasuries that were a perfectly safe investment at the time, certainly considered very credit worthy. But we all know that come 2022 and 2023, the Fed starts increasing interest rates at a historic pace, right? The rate at which they went up has really never been seen in the past. And what happens to all of those treasuries that they own is that the face value starts dropping because their old bonds have a lower interest rate than the new ones coming out. So the treasury face value drops. Of course, that all reverses itself as those treasuries age, but they had particularly long-lasting treasuries, and thus it takes a while for that to reverse back, right? So if you buy 100 million and you're going to get 10 years later, you're going to get 100 million back. But depending on what interest rates do, face value will change. So at this particular time, face value is down. Well, all of a sudden now tech startups here in 2023 are not doing that well. So a lot of them are having to cover their operating expenses by taking withdrawals from the bank. I've still got this cough, feeling a lot better, but bear with me to get through the video here. So there starts to be a lot of withdrawals, and that Silicon Valley has to start selling these treasuries in order to cover their withdrawals. It's not that they didn't have the money, it's just that they have to sell this asset that, even though it's extremely kind of risk adverse, it's actually lost quite a bit of value, which is like a perfect segue into my Wednesday. This Wednesday, I'm doing a webinar on risk. You can find it on the website. It's all about, kind of what risk really means, especially with bond market and everything. But anyways, back to Silicon Valley. So they have to start selling these, and this kind of gets out that they're in this situation where they're having to take a loss on these treasuries. And this very well-connected, very tech-savvy industry who largely supports this bank all start talking that, well, maybe we should get our money out of there. And through their smartphones and whatnot, they start moving all of their assets. These are a lot of companies with like millions of dollars in holdings, and they start removing them overnight, and the bank just can't keep up. And ultimately, the Fed has to step in and help. So here are the major articles. This was the bank. This is the story. It kind of talks about how social media in the world of bank runs is not a good recipe. And this talk about, were they bailed out? Effectively, yes, is the short answer. Were they bailed out by the U.S. government? It's kind of being handled in an interesting way, which I'll talk about in a minute. But they were FDIC insured, but it says here only about 90% of it was FDIC insured because they only cover up to $250,000 per account. So this would not all have been covered. This talks about how the Fed actually is, kind of covering it. And effectively, the plan is these treasuries that they own, they're effectively going to honor them at face value instead of market value to somewhat cover this. And then they talk about a special assessment on banks. So, again, this is not that the money wasn't there. It's just like the rate that it was coming out, the bank just couldn't keep up with it. And thus, they were really worried that this was going to kind of balloon into other banking sectors, right? Kind of traditional banking. Bank of America, Wells Fargo, things along those lines. Um, this talks about what's happened in the bond market since this time. This has been really interesting. Where is it here? Yeah, so the 2-year Treasury was paying 5% last week. If you remember, just last week, Powell was talking about effectively how interest rates going to have to keep going up because the economy continues to do well. Inflation might get sticky. They want to keep raising rates. So short-term rate, we're really high. And then it was already down to 4.1, I think, by today. So 10-year Treasury had moved a little bit, but not as big of a deal. So the bond market's moving a ton. When we look at the stock market was nuts today, all over the place. We started down like 1%. If you look at the one day, that was the week long. Started way down, then we were up as much as like 1.5%, and then we just right at the end we kind of slid here. The first time I recorded this video, I think it started like here. We were up like 0.3 and then down 0.2 by the end of the video, but the market's closed since then, so quite steady here. And then the last thing I want to cover, this is actually from LPL. They kind of cover the story as well, but they have a really great chart down here at the bottom, which kind of covers the banking industry as a whole. And in other words, is this a problem with the banking industry, or is this just a problem with SVB? The truth is kind of both. SVB had 60% of their assets in these securities, which is a lot, but there are other ones, Bank of New York, pretty close. A lot of the other ones are kind of in the 20 to 30%. And then, this is deposit growth. So this is whether money is flowing into or out of the bank, right? So 8% isn't really that much of a year over year withdrawal, right? The problem is that once the run on the bank started, which I'll comment about here in a minute, a lot of these other banks are growing or not seeing this. This other bank, Signature Bank, this was kind of tied up in this, had this big withdrawal rate. But so then let's talk about what does it really mean to be a run on the bank. I'll put my head over here. These people over here that are in the Great Depression, run on the banks, take all their money out because they lose faith in the banking system. They're putting it in cash. A CEO of a tech startup does not take 60 million out and put it under his desk in cash. They just move it to another bank, right? The article of kind of what was happening this whole time is just littered with they're just moving it to a different bank. So have we lost faith in the U.S. banking industry? I don't see that. I don't see Americans going to the bank and getting out cash. The world just simply does not operate in cash anymore. However, there are lots of other banks that are in a very similar situation in which they had, higher deposits than normal in 2021, 2022. They put it in a low risk investment like a treasury, but then interest rates have gone up so fast that all of a sudden these treasuries are underwater. This is not simply limited to SVB. I really don't see this spreading to the rest of the banking industry, but this is kind of a monumental event that people should watch. Now, the bigger news story, which was on the main page there for the Wall Street Journal, is about how is this going to affect the Fed's rate hike plan. It will undoubtedly affect it, right? That's why the 2-year Treasury went from 5% to 4% is speculation, right? That's a lot. That's billions of dollars being bet on the fact that maybe interest rates will not go as high because that's going to exacerbate this problem with the banking system that these treasuries are underwater. And maybe we raise these a little bit too fast. So I really don't see a whole lot of huge concern. This is going to turn into like a 2008 global financial crisis or anything along this. The Fed is acting pretty quickly and pretty aggressively, and they are also the ones that control this interest rate hike. So I think we will. It's going to be very interesting to watch, and we will cover it here undoubtedly quite a bit. So if you are interested in following this, just continue to watch. If you have any questions about it, just shoot them to Mike at Canavanwealth.com. And like I said, I have a webinar coming up this Wednesday, and you can get to that on the website. We have a webinar every Wednesday or every month, and I will talk to you soon. Thank you.